Hello, my name is Brian Overby. I'm known as the Options Guy, and welcome to Options Guy TV. I'm also the author of the Options Playbook, and this was the inaugural week of Options Guy TV, and what a week it was. We decided to kick off Options Guy TV at the beginning of earnings season. We had a lot of big stocks that we're announcing this week, including the financials. So we started on Monday by just getting bullish on the market ahead of earnings. And I have a chart that I want to share with you in the S&P 500 index, and I'm going to do that here shortly, just showing what has happened in the previous 7 or 8 earnings quarters as far as the market is concerned. And then on Wednesday, we came back and we looked at a trade in Netflix. We looked at a butterfly trade around their earnings, mainly because they announced on a Wednesday and there was only 2 days for the Friday expiration options to live. And we got a lot to look at as far as the dynamics of the pricing of that butterfly is concerned. So today on Friday, we're just going to spend time reviewing those 2 trades because we have so much to talk about in those 2 trades. So I'm going to start with the trade that we looked at on Wednesday, which it didn't turn out too well. If you look at how we set up the trade and all the procedures that we went through to pick the strikes and limit our risk, they worked out just fine. We knew that we had to get the direction right, and we did not. So with that said, we talked about an expected move in Netflix by looking at what the long straddle was trading for. And it's kind of understood in the marketplace that if you look at the expected move ahead of earnings, it'll give you some hint as to what I defined as an over-under on what could happen after earnings. I do want to emphasize that if you're looking at a 2-day option contract, which that would have been, obviously we're looking at the expiration for that Friday, well, then that's the expected move over the 2 days. So in theory, a lot of people just look at it because the move really normally happens in a big way right after that earnings announcement. I think everybody kind of understands that. But the one thing that I'm going to point out on Netflix is that after the close yesterday, it made exactly the expected move. It just went in the wrong direction for our trade. It moved 44 points on the nose, which is what the long straddle was trading for on Wednesday when we looked at that trade. And one thing that I want to emphasize too is that if I am doing an earnings trade and they're announcing after the market, we are obviously doing our webcast live, dealing with live markets at 11 a.m. Eastern time. But I would probably enter that trade a little closer to the close. And the stock did move fairly substantially going into the close ahead of their earnings. It made a decent point move, not on a percentage basis, but it moved. I think it moved up a bit. So with that said, let's start by looking at the Netflix trade on Wednesday. So I'm going to show you my screenshot of the Netflix trade. Okay. So if I pull up that screenshot, we're looking at the market at the time was 49.35. Both of the at the money option contracts were trading right around $22, $23. 21, I think it was 21 and 23. We weren't exactly at the money. It was the 49.80 long straddle, if you were to buy the long straddle. So very expensive option contracts at the money, a lot of volatility, a lot of juice. One of the things that's awesome about the TradeHawk software is that if you look up here, it actually shows you the at the money IV and the historical vol to go along with it. So the IV is around 145 because of the earnings. The historical vol was right around 50. And guess what? Right now I'm looking at live on the TradeHawk software on my other screen, and the IV is now trading right at 50. Okay, so just some hint that it did collapse quite a bit, over 100 points, and started trading closer to its historical volatility. All right, so with that said, we went out the expected move. We bought the strike that was 44 points up. It's once again, it's not an exact science the way that we're looking at the expected move. We're trying to take supply and demand in the marketplace and option pricing calculators to give some hint as to what the marketplace is thinking. The over under, right? It'd be over the expected move or under the expected move. and it's no regard to direction. So I'm giving a lot of caveats here. But if you look at it, we just kind of rounded off when we said, all right, from 40, 80 plus 44, we're looking at about 524. So we're going to buy the 525 strike. That simple. So we did that. Then we went up 15 points. We sold 2 of the 540s. And then we went up another 15 points and we sold 2 of the 555s. All right. Able to get that done. Now, when we were online, when I took my screen grab, it was 75 cents, but it was 67 cents when we looked at it. And I want to emphasize how much we were lowering our cost, right? So if we compared that to buying the 525 option contract, the strike that's going to drive this trade, if we're correct on our forecast, that would have been on the ask price $755. So you're talking about $755 versus, we'll say 75. That's fine. It was a little bit cheaper, but versus $75. So the amount of risk is a lot lower on a 1 contract trade. So in a butterfly, a 1 by 2 by 1 is considered 1 unit. And I guess it'd be better to say, instead of contract, it'd be better to say a 1 unit trade. So your total risk by doing the butterfly is $75 plus any commissions that you would have to put that trade on. And as always, we talked about this as a paper trade, emphasize the fact that this was a speculative trade because of earnings. And if we were just going to buy that out of the money option contract, well, we'd be looking at paying $740. So it make you think twice. Had a lot to do with the fact that it was 150% implied volatility. Lot of issues there. Okay, so the market went the wrong way. As far as our trade is concerned, we could say the market should know what we're thinking, but the market obviously didn't. And the market did move the expected move to the opposite side of the screen. So it closed on the close down 44 points. Yesterday, it closed at $4.35. So if I go back and look at, let's do something different. Let's say, because I just want to learn here on Options Guide TV, I want to learn about the dynamics of pricing. And I don't think you can really do that as well, especially around an earnings trade, by using a pricing calculator. We're going to look at the what if calculator here, just at a butterfly, just in general. We're going to kind of go through that a little bit before we move on to the SPX trade that we did on Monday. But if I'm looking at this scenario, I want to see how did it price over the next few days. So I'm going to go back to the next chart that I have, and I'm going to say, if we would have used our same rules and we would have set up the butterfly 44 points to the downside, and we did mention that on Wednesday, that if you wanted to be bearish, it's possible. You could be bearish in Tesla too, because Tesla was announcing earnings and they actually came very close to their expected move. It's not always that way. I mean, it was pure luck that it was the exact expected move. I mean, there's no doubt about it. But let me go and pull up the next one, which would have been Thursday. Okay, so I got up on Thursday. I looked at Netflix. I pulled up the Trade Hawk option grid, and I set up that butterfly. I said, okay, if it would have been 44 points below where we were talking on the show, which was 479.35 minus 44, we're looking at that market, and let me be big, at 435. So I took everything that I did and said, hey, now we have the hindsight of knowing which way it's going. So let's pretend that we put the butterfly on the exact same way on the opposite side. And I only want to do this because I want to emphasize what I talked about on Wednesday, and as far as the pricing is concerned. Now, the butterfly should have been fairly similar to the price of the, it should have been very similar to the price that the call side was on. And equidistant in and out of the money, usually option contracts are going to be fairly similar priced. Now, There's something called volatility skew, and I don't necessarily want to get into that too much. But if I look at this trade and I share with you that that screenshot on Thursday, we'll see if we put it on for around 75 cents, the market on Thursday on the open, right at about 10 o'clock, 10:30, which is when I would normally look at it. You get the big spike down and everything. We see here's where the market would have been. 435. 435 is the strike that we would have bought on the put side, right? Because we were bearish. 420 would have been the put that we sold, and 405 would have been the put that we bought. Now the market hadn't moved the full expected move. And I emphasize this because on the call I said, well, if you're going to put this on for about 67 cents or 75, let's stick with 75 because that's what the screenshot said. Okay, for 75 cents, don't expect to make $15 tomorrow, right? The maximum the butterfly can make is $15, but you have two option contracts that if you're correct on your forecast, that middle strike that have to wither away to nothing before you can make that $15. So if you get a doubler, get out, right? If you get a double or a triple on it because it's moving in the right direction, and I want to emphasize that it didn't get to that strike. We had the vol crunch that came down. Notice it's showing the IV here is at 58. Today it's at 47, but that vol crunch came down from 150 down to 58. That helped us because if we were on the put side, we saw this go from 75 cents to $3. So I would have got out. I would have 100% closed the trade right at that moment. Because that's what our goal was. Now, if we had bought the 435 put, right? Well, yeah, because so I started by comparing what the price of the call was, which was about $7, and the risk was $7. So I should also say that reward, this put is now trading for $58. So you would have had a risk of $7, but obviously you would have knocked it out of the park if the stock would have went the way that it did and you would have owned the put on the other side, because it's now trading for $58, a lot more. Okay. But that's not what this trade was about. It was about managing the risk, especially around an earnings forecast. And if you wanted to do it on a 5-lot basis or a little bit more, that's fine. But understand that if the market does go your way, you're going to lose some money. And if the market goes the other way, right, in that instance, well, then if the market goes with you, you're not going to hit that home run like if you bought that option outright. But if the market goes against you, you're not going to have that huge amount of loss either. Okay, much easier to manage the risk. The call side is zero. There's nothing to save. You might have been able to get out on Thursday morning for a dime, but you would have had to act really fast. Okay, so that was done. So now let me go and look at, so the Thursday trade, I'll show it one last time here, was trading for 308, and I would have closed that trade. So now I'm going to exit this, and we're going to go live. All right, I'm going to come back and we'll look at the SPX trade that I did on Monday. But right now I'm going to go live, and let me share my screen here. That's not the view I want. 1 second. Yeah, thank you. All right, there's the view that I want. Okay, so right now the market has continued on down. So it's gone beyond the expected move, which is fine. And it's down 8 today. Yesterday it closed at 435. But if I look at it now, I just want to highlight the maximum that it could trade for is $15. Right now, when I got on, the market was right at the midpoint of our trade here, which would have been 435. Here's where the at the money option contract is at. This is the midpoint where it would have been at, and it was trading for $8.90. So one thing that I don't want you to do is say, oh, I sold it at 3. I can't believe how big of an idiot I was. I could have sold it today for $9. I hate comments like that. When you have a plan and it happens, you stick to the plan. You move on to the next trade and you go. We're trying to learn here. I wanted to show you the dynamics, how big one more day of time decay is, because we did get a little bit of delta. We got a little bit of a move to the downside too, but right at the money with one full day of trading left, you almost got half the value of the butterfly. Well, a little bit more, right? So $8.90 was the midpoint. Right now, it's bounced down to $4.28. It's trading $8.25. Still really good. Maximum upside would have been $15. So if you did miss the move yesterday and didn't get out, and in my mind, I like to say you got the stupid award for not sticking to your plan. Well, then you would have woke up this morning with a little bit of a bonus, and that doesn't usually happen that way, but in general, you would have, and you'd be able to sell it right now for about $8. That's about where you would get out at. So I put this in the what if. I'm learning the TradeHawk software, and I'm really enjoying it. So I just thought I threw this in the Netflix. This kind of shows we started way up here, 480. So this is where the market was when we looked at the trade on Wednesday. Here's where the market's at right now. Right around last trade was 48.25. So it's right here. And this would be where the home run would be, right in the middle, 435. And that's how the butterfly looks, right? If the market goes up, you lose what you invested, which was only 87 cents. Market goes down in this instance, or if it jumps way up, that was probably the most frustrating thing that I've ever done on butterflies around earnings, which, I don't do a ton of them, but I love to talk about them on my show, mainly because the pricing is so interesting. And if it jumps way up above, that's the most frustrating thing. You get the direction right, and it opens down double the expected move, like 88 points would be double, right? And you just didn't get that opportunity to get out because of the gap opening. So those are the bigger concerns, but it's really hard for it to move double what the expected move is on the opening. So this is where it's at. This is what it looks like in the profit and loss graph. At the end of the day, this is what the graph will look like exactly. And you want it to drift back up towards the 435. So, if I did have maybe 5 on, if I would have put 5 butterflies on, maybe I would keep one and hope that I hit a home run on it, But if I just had a one lot, I would have got out of that trade yesterday because I reached my goal and I achieved it. All right. So let's go back to the TradeHawk platform, and I'm going to type in SPX here and just get that up and running, get that chain running. And I do want to change up my grid format. Open interest and volume. All right. And I want to look at some intrinsic value. We'll look at the intrinsic value a different way. That's how we'll do it. Okay. I don't have that up and running. So let's pull up. I'm going to pull up one more trade. This would have been Brian on Monday. So I'm going to show you this trade. And this trade paid out right away. Actually, before I go there, I'm getting a little bit ahead of myself. I talked about this on Monday's show. I talked about what has happened during earnings. I kind of had an epiphany today that let's just go back, and I'm going to look when, to me, the start of earnings season is when JP Morgan announces earnings. They're the first bank to announce. The next week, you get the first FANG stock to announce, which is normally Netflix. And then next week, you'll get the big dogs. You'll get, well, Netflix is a big dog, but you'll get Google, you'll get Amazon, usually Apple. So that's the kickoff to earnings to me. So what I did was I went back and I said, over the last 7 or 8 quarters on the show on Monday, that after earnings, we've seen a decent run up because what the Fed is trying to do wasn't hurt. Well, the company's earnings reports were better than expected based off of how fast the Fed was raising interest rates. Okay, we'll leave it at that. So here's when the downturn was. So this was JP Morgan's earnings. That was the day that they announced earnings. And you saw we had a huge move down, but this is also the start of the downturn. The Fed's going to raise interest rates. This is all these different things, and it just couldn't hold. And now a big thing that I want to highlight on this graph too is the moving averages. We see that this is a 200-day moving average on an 800-day chart. It stops about right here. But interesting that we talked about the golden cross and the death cross. It's just a data point. But I always like to notice when the 50-day crosses over the 200-day. And if you just use the formula, right, when it crossed over here, this was the 20-day crossing over. And you guys can see my my cursor, I hope. But when I cross over the 200-day or the 20-day, that was the beginning of the downturn. And then we saw the 50-day crossover, had a little bit of a spike up. But if you would have gotten out of the market there and then waited until the golden cross happened, right? See where I'm going here? And I'm looking on my other screen over and I'm pointing at it, which I'm not really sure if you're seeing that or not. But that's the golden cross, and you get back in, the market's fairly strong. So it worked this time. It doesn't always work, but I find it interesting. I think it's more important in things like the S&P 500 index and around major events, right? We went basically all the 20-day was below the 50-day, below the 200-day, all signs of a weak market. And now we're finally back to where the 200-day is below the 50-day, which is below the 20-day. So we got our ducks back in a row again, and we've had a real strong movement in the market. It's getting a little bit frothy just in general. All right, so earnings. If I go back and I look at earnings, let me see if I can draw something. And can you see my cursor? Thumbs up or thumbs down when I'm in the picture? Down. Okay. All right. So I know that everything that I was pointing at was not working out. No big deal. We'll get that glitch figured a little bit later. But let's just go all the way back to the first line that I have drawn. All the way back in January 22, that was the downturn. Go to the next line from that, and you see earnings came out, had a little bit of a run up, bumped against the 200-day moving average, and then the market just started to fall off. Once again, we go to the next quarter. This one would have been so that was April. So now we're in July of 2022. Earnings, once again, JP Morgan, that's their date. Market had a nice run up, a little blip, bounced off the 50-day moving average on the downside, ran all the way up to the 200, bounced off of that, came all the way back down until what? The next earnings report. And once again, we came up, but the Fed kept speaking and they kept raising interest rates. The market just couldn't sustain, sold back off again. Then let's go again to the next one. So now I am looking at the bottom of the chart. It's 2023 of January, another earnings season. Once again, ran up. Fed keeps pushing, market falls off. Then we go again, once again, a decent run up, a little bit of a fall off. So that was the rationale behind getting long this week after JP Morgan's earnings, the start of the earnings season. That was the rationale, and we see what happened. So now if you go all the way over to the far end of the chart and you look in July, we see that's when they announce earnings. Real strong week in the marketplace, and a trend works until it doesn't, right? I mean, if you look at it and you go back, we got a trend. I would consider doing this again. The next round of earnings, the same type of trade that we did this week. But if it doesn't work, you just manage your risk, and that's how you deal with the trades. All right. So I wanted to share that screen with you. I'll figure out how to be able to point a little bit better once we get up and going. So let's go back to me here and share my screen. There I am. Okay. And let's look at the SPX trade. So I had a very interesting question from somebody outside of the podcast asking me about the setup, because I did go into detail about the fact that if the market didn't move on our SPX trade, which I guess I should share that. Let me go back. I'll share it one last time. We'll look at this. Okay. So Monday show. All right. So the SPX trade, I want you to focus on the bottom half of the screen and look at what the cost of the trade was. All right. The market was at the beginning of the week was 45.20. Right now it's 45.48. Had a good up move in the SPX this week. We sold the most at the money option contract, and we then bought the just one strike down in the money, 5 points in the money. And we paid $2.95 for it. Now, if you do the math on it, that means the break even on that trade would be the $2.95 plus that bottom strike of 45.10. So it would have been 45, and then we'll add three points. Let's just add 3 points. 45.13. That's basically the break even. Well, the market was at 45.20 at the time. That's what my screenshot shows up on the top. So that meant that if the market just stayed there, we were going to be profitable on this trade. So interesting enough that how does that happen on a debit spread? And so because of the question that I received after the fact on the show, I thought I would emphasize that this happens. How you can set up a spread to be theta positive or favor time decay, even though it's a debit spread, is we would sell more time premium than we bought. All right. So we sold the most at the money option contract that was almost all time premium, and we bought an in the money option contract that had a lot more intrinsic value and hence had less time premium. And when you do that, your break even will be below the market. Now, you can't do an out of the money long call spread and have that happen, right? You have to do something around where the market is at in order to accomplish that goal. Because if you go further and further out of the money, everything's going to be extrinsic value or time value. So the only way that we could set it up that we would be profitable if the market just stayed where it was at, or if the market went up, it could even gone down a smidge and we still would have been pretty good on that trade because time decay would have been huge over the week in a $45 index. So that I just wanted to emphasize that because I thought that was a really good question overall. So if you're looking at just an at the money option contract right now, if you look at the put side, that'll tell you the extrinsic value of the call and the intrinsic value and how much time value is in it, right? So if we were to set this up today and just do a 1 day trade, we're still on the July 21st expiration. You see that if you bought the 54.45 and sold the 40. This is what's tough about the SPX. There's just too many numbers in it because it's such a long number. All right, let's start from scratch. If you bought the 45.45 and that was your long leg, so let's just put it in there. Let's just do that. Okay. This isn't a paper trade for the week. I'm just going to put it in here. Let's clear this out. And let's buy this. So I'm going to hit the ask. And let's sell this. I'm going to hit the bid. All right. But I'm going to focus on just the ask price here on the puts. Now, this isn't an exact science when you're looking at the put side of things, but that means that you're selling about $5.60 worth of time premium on the 45.50. And you're buying, let's call it $3.70 worth of time premium on the 45.45. Now, it's a much more expensive option contract, without a doubt, right? It's going to be more expensive, but less of it is time value. You have more intrinsic value. So if you did this trade, you would have the same scenario that if the market just stayed at 45.50 and it just stayed above that, you would have a profitable trade. You would have paid a debit for this trade, and you would be able to get it done for you would have paid a debit for the trade, but if the market didn't move at all, you would be profitable on that trade overall. All right, so let's open it up for questions. If you have any questions, let's put it in the comment box. We're coming to the end of the hour here. All right. So how do you determine, here's the first one from Max. So that's already up on my screen. That was quick. Okay. So first one from Max is, how do you determine your exit points for a butterfly? How do you decide what your minimum acceptable profit is? Great question. If I'm looking at that trade, I don't want to be greedy. And a lot of it has to do with how I am setting it up and my expectations of time decay over that scenario. Okay, so we set this up on a Wednesday. There were 2 full days to trade. Amazon always announces on a Thursday, and I kind of like that scenario better because there's only 1 full day to trade. But we taped the show on Wednesday, so we looked at a Netflix trade. So when we put that trade on, what happened was the next day, if we were correct on our forecast, my expectations based off of time decay, potential volatility crunch, would have been that a good trade would have been to double what I paid for it. So on a butterfly, whenever, I guess if I were to make a rule of thumb, whenever I could double, that means if we bought it for 75 cents and we could either sell it for 150 or 225, somewhere in that range, I'm going to want to get out of that trade on a very short-term basis. I very rarely want to stick around and let that market move too hard against me. So that would be my outlook. Now, if it would have maybe had 1 day, I might have stayed a little bit longer with a 1 day because of time decay. But in that scenario that we had, I was very happy that if I put it on for 75 cents to get out around 150 or $2 on the upside. And that would have been my expectation. All right. Next question. How often do you monitor your trades during the day to check for your exit point? Well, it was a paper trade, and we usually just talk about paper trades on Options Guy TV. But after earnings, I'm usually looking right around the 10 o'clock hour. I let the noise of the first half hour of the marketplace kind of filter out, and that's when I really think the markets are finding its footing, is right around that 10 o'clock, which means I'm in Eastern time. So the market's open at 9:30, so a half hour into the trading day. But yeah, I would look at it periodically, and I would definitely have an alert set on different prices on that underlying stock. So easy to just look at your phone and figure out where the stock is at, because the stock's really going to drive what I'm going to do with that trade. So I'm constantly looking at my phone throughout the day. I want to be online on my computer. I don't want to try to trade options necessarily from a mobile app, especially a trade like a butterfly. So I'm definitely going to be on my computer at the open for the next half hour of the trading day, without a doubt. But I will do butterfly. I'm not scared of a butterfly, especially if you're doing it for a risk percentage that you're comfortable with. You know, we did a 1 by 2 by 1, a 1 unit butterfly. And that's where we're at. All right, I got another one. And then I see we're going a little long. What percentage of time decay do you expect to cover the last couple of days of the week? Yeah, well, just SPX. Let's just talk SPX, because I've traded a lot of SPX options. Wednesday to Thursday, you get a good amount of time decay. Monday and Tuesday, there's not a ton. And then Thursday, all of a sudden you get, it's like wham, my sled hit the tree. When you go from Thursday to Friday in a very expensive underlying like the SPX, you will see a huge rate of time decay. So we got the July option contract. It's still trading at $14. Well, here's a great example. You can just do the math on it. You have half a day left, and this at the money option contract, which is almost exactly at the money, that's got to go to zero. Well, $6. It's got to go to zero. I'm looking at the ball, not that. So we got $6 worth of time decay in half a day. We can look at theta, and I'll pull up. Let me pull up a different grid here. The Greeks. Okay. And you can look at the theta of that option contract. Well, it's a 1 day theta. It's not a 1 hour theta. So I guess it doesn't really work. Let's look at 2 days. Let's see, 0 days, 4 days. Okay. So this would be the July 25th expiration. And you look at theta, you know, it's saying that this $17 option each and every day is going to lose $200 on that position. Every single day, that's how much theta, theoretical, here's a bid. Yep, that's how much theta this option contract is going to generate and lose on a one-day basis. So it's huge. It's huge. And then you throw in some volatility because you got earnings in that, and you see you got a recipe. You got things on your side if you're correct on your forecast on a butterfly. Yeah, it's the more expensive the underlying, the greater the theta is. All right, so I think that's going to be it. We're a little bit long today. We'll come back Monday. We're getting this all figured out on Options Guy TV. Please give us a thumbs up. Always appreciate that. And then we'll come back next week with another plan for the week as far as Options Guy TV is concerned, and talk a lot about strategies, specific strategies, and how we want to approach them on a specific underlying. Thanks for coming, everyone, and hopefully we'll see you this Monday for the next edition of the Option Guy TV.